Hi there, welcome once again to the Dukascopy TV studio here in Geneva. I'm Ben Jones. Alongside me from ROX International is Filip Nys. Filip, thank you very much for joining us today.
You're welcome, thank you.
So you're in the studio today obviously to discuss the girl's best friend, diamonds, but can you give us a bit of background about ROX International? What do you particularly focus on?
Okay, so ROX International is a company I founded 5 years ago, exactly 5 years ago, after spending, roughly speaking, 16 years being very active as an international banker for the two main financial institutions, being ABN AMRO, a bank quite well known in the global financial industry, and also the Antwerp Diamond Bank. Both banks take account about 50-60% market share in delivering financial services to the diamond community. Now, what was very special about that journey is that I noticed by being active in all these countries, with all these families in the diamond business, I noticed that once you're in that business, I mean, things are like completely transparent. People are open. There's a lot of course, social control. You need to, I mean, as financier, you need, of course, to know the nitty-gritty of each family, of each company in order to assess risk. And at the same time, while being in Geneva, I also noticed, because a lot of my friends are based in the financial industry, namely private banking, investment banking. And I said, I mean, how come, I mean, what is this business? This diamond business, it's so glamorous, you see all these, it's fashionable, it's investable perhaps, but we don't know this business. So from the one side, you have this diamond business, which is, once you're in, which is very transparent in a certain sense. But from the outside, it is quite, call it obscure, or we don't know, etc. So after spending 16 years of my life in banks, I really said it's time, being an innovator and an entrepreneur also within these banks, to set up my own company and to try to bridge this gap between the diamond community, being investable and quite risk low, etc., but non-transparent, and the investment community or the financial community who is looking, I think, all the time for financial or for alternatives for investments in the quest for diversification of portfolios. So that is what ROX. I mean, ROX, the name itself, it's I think it has three features. ROX, it means big stones. It also means a rock, something quite solid. It's a hard asset. And then thirdly, I think something which is also close to me, ROX is also a bit rock and roll, meaning quite dynamic, young, and innovative. So that's why the name ROX International. Now, as the focus of the company, of course, it's all about diamonds. Diamonds, I would say, from two angles. One is the investment side, as I mentioned, to bridge this gap between the diamond community and the investment community. And secondly is also to be active on the corporate side, where certain institutions and also diamond families, etc., are in need of seasoned professionals which guide them on strategy, on finance, on corporate structuring, and so forth. So, but the focus, of course, is diamonds in the large sense.
Okay, so you mentioned obviously investment. What potential is there for diamonds as an investment? Can you give us an overview of the past few years potentially and the current performance?
Okay, I mean, there's a lot of stories about diamonds, and I think people who, you meet people from different variants, and they will tell you stories about, it has done well, but most of the time people will say, actually, we don't know. So in order to make it very objective, and then also in line with us, ROX being innovators in the industry, we contacted, let's say, the main institution in terms of analyzing performances and risks on alternative assets, which is the PhD department of the University of Tilburg in the Netherlands. And under the leadership of Professor Renneboog, we established a database of 4,000 public sales, which took place between 1999 and 2012, had them analyzed by their team, and what we discovered, I mean, on the what I call investment grade diamonds, I call them investment grade. It's about 5 carat and up, let's say a budget of $100,000 per stone and up. What we found that on an annual basis, diamonds performed, and this is just basically natural growth in price, roundly speaking, 8% per annum gross. If you take out inflation, it comes to about 5%. So actually, it has done quite well. And if you compare it to equities, bonds in that same period, it has been more performant than any of these other asset classes, except at that time gold as well. Gold was doing quite well in that period, and now you see gold going slightly lower. So this is one thing. On the investment grade diamonds, I would say in general, on diamonds, the smaller they are, the lesser they're prone for investment. We see that in the price evolutions, where let's say from 1980 till now, below 0.5 carats, which we call 50 points, have been done quite flat. And we see the more you go into higher carats, so in higher weights, the returns are becoming more interesting. For instance, a typical 1 carat stone has performed, roughly speaking, 4-5% growth. What does it mean? It not only protects you from inflation, because inflation during that period has been around about 3%. So it also gives you another little premium on it, and it diversifies you versus the other asset classes. We've seen in 2008, 2009, in the height of the crisis, diamonds have corrected, but not that much. And actually after, like 6 months after the equity crisis, and they recuperated much more faster, mainly because of supply and demand dynamics. The big driver, actually, one of the big drivers of the price, I mean, call it, it's quite stable and it's rising, is the unbelievable supply-demand dynamics. So you have a very flat supply, I would say, and you have year-on-year increase in demand.
Yeah.
RBC has studied that. It's a 4-5% per annum increase. So actually the prices rise naturally because the product is limited in its supply. You have 2 major companies who have 70% of this business, which is De Beers and Alrosa. And they, I'm not saying, well, let's say in times when it's, kind of crisis, they limit or they try to manage supply to the market. Okay. So price volatility is quite low. And there is a direct correlation between demand and, for instance, population growth. So as long as you have more population growth, you have more people getting married, you have more people asking diamonds. And the third one, which is of course everybody knows, is that the proportion of high net worth and ultra high net worths in the total population have increased dramatically. The rise in prices in these higher categories of stone or investment grade of stone, being the more bigger carats in the white goods, but also colored diamonds, for instance, have done particularly well. So I think that's also one of the key points to point out why this asset class actually has performed quite well versus also other asset classes.
Okay, so how does one get exposure on this particular asset class?
I think there are 5-fold ways where you can get exposure on the asset class. I would say one, there are listed companies. People can buy on the stock market. They're mainly based out of Toronto, like a lot of the mining companies, or they're in London, being either London Stock Exchange or AIM. Just to give you an idea, the diamond junior or mining companies have outperformed in 2013 most other commodity plays. Take up Lucara, take Mountain Province, look at Petra Diamonds, all very, very valuable success stories. A second way to invest in diamonds, of course, which we've seen also the last 10 years, is the auction houses. People have been buying diamonds through auction houses. Sotheby's Christie's being the main leaders in that field. A third way is, let's say, a very classic traditional way, is that the person goes to his jeweler and asks for call it rock, a big stone, have it set and try to get a good price on it. Of course, we all know what these retailers, you know, add in terms of margins. So I can't always say it's a very low cost, transaction cost investment. A fourth one is private equity. There are plays in the diamond industry which we can invest and which are not listed. And a fifth one is like people like me, which are truly independent professionals, where we actually look at the profile of the client. We analyze his risk appetite, we ask for what his return expectations, and also very important, we manage an eventual exit, because people want to invest, but also one of the, let's say, characteristics which most of the other people are not discussing is the exit. We also discuss the exit, and then we try to fit a product or a service which is fitting exactly in the profile of this investor.
Fantastic. Filip, thank you very much for joining us today.
Thank you very much for having me on board. Thank you.
And thank you for watching. Do make sure you keep clicking back to Dukascopy TV, as we'll be bringing you plenty more updates and exclusive interviews. Bye for now.